Very good morning. Welcome to the second day of the Global Finance Conclave. My name is Ashish Bharadwaj. I'm Dean of Jindal School of Banking and Finance. Thank you so much to everyone who's joined us live on YouTube or Facebook. Thanks for being here with us today. I'll be chairing this session. It's the first one of day two. We had 10 wonderful sessions yesterday. Today's session is on financing growth and growing finances. There are two parts to this session. We'll start with a keynote address to set the stage, contextualize the topic, and after half an hour, we'll form a panel and we'll continue the discussion. Our keynote speaker is Mr. Ajit Pai, a distinguished expert who's driving the economics and finance cell at NITI Aayog. He oversees public disinvestment, which means that the last few months have been rather very busy and exciting for him. Important files, I'm told, on finance from Manila, Washington, D.C., Paris, New York, usually lands on his desk, and that's to his versatile, multidisciplinary technocrat. Some know him as an astute economist, some know him as an architect trained at Yale. He's also the chair of the Delhi Urban Art Commission. He's been an award-winning financial forecaster. Thank you so much for being with us today, Mr. Pai. With this, let me invite you to deliver your keynote address.
Good morning, everyone, and thank you so much, Dr. Bharadwaj, for a very kind address, but also very importantly for this opportunity to do two things. One is reach out to young minds, like the ones that are likely listening to this session. And secondly, to deal with an issue that I think, or rather a narrative that we would like to change. So I think the topic itself is a very, very important topic, which is that, finance and how it impacts the growth. The growing finance part is the one that I think I will focus more on. What we really want to change in terms of the way people think about the asset monetization, strategic disinvestment, the strategy that is mentioned about this session that was highlighted in the document, the flyer that was sent out. Was that the government embarked on a strategy of this asset monetization to actually accelerate growth. But many people, and I'm not saying that it's restricted to this audience, but the way the media reports about it, the way many people think about it, is mainly they are looking at selling government assets to bring capital to finance the growth. That understanding is probably not the best understanding of what's really driving the strategic disinvestment and shifting these assets from the public sector to the private sector, or looking at the PPP transactions. While I will not sort of deny that that is a very important benefit that happens, what is central to the strategy is to bring efficiencies to the overall Indian economy, bring greater growth through those efficiencies. And a lot of people ask, why would that bring greater efficiencies? Why would that bring greater growth? And I think what I would like to do is spend a few minutes on some fairly sort of fundamental observations about the Indian economy and what I think the Indian government has understood about it and the steps being taken in the past 5 to 6 years to change that, to accelerate both the economic growth, but also the relationship with finance and how to accelerate it. The first, I think a lot of you are familiar with that India's savings rate is significantly lower and capital formation is significantly lower than some comparable countries. The easiest to point to right now is the other very large economy, which is now the second largest economy in the world. And you look at China's investment rate and you look at its savings rate and you look at India's. And when you look at that, you'll see that it's primarily a state economy, state-run. Why is there such a great need, to shift things from the state to the private sector when China is doing so well, with that and very high capital formation? And to that, we start spending time on looking at what really changed in the Indian economy relative to the Chinese economy. What do we have in common and what's very different? And what we find in the very low capital formation in India, which I think is a primary driver of growth, and we'll go through some of the reasons why, is the fact that India was not globally competitive. That for a very long period of time. So we both started out at both economies started out at a very similar with a very similar kind of per capita GDP. When you go back to the 40s, we are looking at both India and China, sort of, fairly low single digit. Both countries went through a massive acceleration early on in the post Second World War period. By the time we reached the early 60s, we had both countries having per capita GDPs close to 20%. India actually was ahead, China slightly behind. Suddenly, in the next, 3 decades, all the way to the early 90s, what we observe, not in terms of the growth of India and China, but what we observe in terms of per capita GDP as a percentage of world per capita GDP, is that both economies had a declining trajectory. So we went from being 21% of global average per capita GDP in the early 60s, down by the early 90s to about 6.5%. So people term that growth rate. Everyone in India was thinking that that's the right way. We are doing, things quite well. But in that same period, about 10 years prior, there were changes in China. While we shifted in the mid 60s to the socialist model, it was added to our preamble, became part of our constitution. In China, they actually changed their flavor of socialism to starting to embrace capitalist socialism, is what I would, call it. And from that point on, we started watching a change from the Deng Xiaoping era in China. The capital formation started to increase. And from the 90s, a decade later, we watched India reverse. But today, while we have made tremendous progress relative to the rest of the world, our per capita GDP as a percentage of the world average has gone from 6.5% to 18, 19%. What is remarkable is that China's per capita GDP that overtook us sometime in the late 80s is now about 5 times what India's is. So we are almost looking at China reaching the world average in 2020. Tremendous thing. And we have to figure out what it is. And as many of you will observe, a large part of that was credit, was finance, especially since 2007. You'll see that China shifted from trade as a most significant driver of the economy to domestic credit. So that leads us to seeing that, okay, where are we as India done in terms of domestic credit? And you'll see out of the G20, other than Saudi Arabia, we are probably one of the lowest in domestic credit as a percentage of the economy. So observing that, we said, okay, that's a very, very significant driver. What are the basic proponents for this domestic credit? How do we make sure that this domestic credit grows in the right way? And what were the barriers to this domestic credit, the most significant barriers in an economy like India? So I think this realization happened over the, maybe 5 or 6 years ago, even before I joined NITI Aayog, maybe not, completely well articulated as we would have liked it for the media to get the message and the industry in India to get that message. But I see two sort of major drivers for that. One, of course, was the profitability, the profit motive. India has been, that socialist sort of thinking has been so entrenched that profit has become a bad word, both for the administration, for the government. Everything that was profit was bad. I think people forgot that, it is that profit, the difference between revenue and costs, that results in capital formation, that can accelerate capital formation. And also that capital formation, that profit is what results in credit growth. Any banker will see how much you're making before they decide how much to lend you, how much you can make before they lend you. So a cap on the credit growth and the fueling of the economy through rising credit. A significant cap was that mentality of the overall system of not being profit friendly. It was redistribution, from taking from the models, business models that are most effective and most competitive, taking the money from them with very high taxes and shifting it over to social redistribution, like all our government programs are geared to do. So that was the structure of government historically. That was the belief that that is the best way for us to evolve. I think we should question that belief, having a look at socialist countries, how well they've done. Whether it's more important to be redistributing the pie and focusing all our energy on redistributing the pie, or whether we should be actually looking at how to grow the pie faster and what we can do. So we talked about one criteria, which was, of course, the system and the way it was geared. But what were the actual technical reasons why we weren't having this. And one reason one would say, that actually there are two main reasons. One reason that I would say is our lack of competitiveness in global markets. And that lack of competitiveness in global markets was driven partially by that system thinking. But what did it result in terms of the structure and configuration of our economy? It resulted in what I would call supporting the small and punishing, with the labor laws, with the compliance, but everything as you got bigger, it punished scale. So what we had about a decade ago was a country which did not have the appropriate scale of enterprise across all three sectors. We didn't have the appropriate scale of enterprise at the micro level, at any level, in each sector. You look at the primary sector, you look at the secondary sector, you look at the tertiary sector. So we were subscale in terms of enterprise. In terms of industry, we might not have looked so bad. You look at the market share in steel and you'll say, oh, India is just becoming the third largest, about to become second, which we are today. We're talking about a decade ago. But when you looked at it at the actual structural level, we did not have the capacity, to be there. We were much smaller, where some countries like a Korea or a Japan would have three players, you'd have 3,000 or 30,000 players that collectively would be the same scale. So that scale was an issue. In agriculture, the average landholding of an Indian farmer went from 27 acres down to 2 acres, completely impossible to subsist. You're talking about the average, down to 1 hectare. And you look at services as well, highly fragmented. So the structure of industry was highly fragmented, lower profitability. Lower profitability means lower credit. The second issue, we'll revisit the scale and what the government, how it's thinking about it to start improving that competitiveness, profitability, etc., that can actually fuel, provides the data, provides the backdrop, provides the security to the lender. But the second, and I think equally critical factor within the Indian economy was what I would call the lack of formalization. So lack of formalization, you'll wonder why. It's because what it does is people that are not formal, the cost of their capital is extremely high. So automatically that slows down both the appetite for credit as well as slows down the ability to repay the debt, and it slows down that overall cycle for the people that are actually borrowing in the economy, not the lenders necessarily, but at least the borrowers. That informal credit in India has gone up. I don't have to mention the numbers about how high those interest rates have gone, but it's gone to several percent on a monthly basis, not on an annual, but a monthly basis. The other thing about the informal economy rather than the formal economy is that the formal economy is the kind of security a banker would require to have 3 years financials, have a look at it, to be able to lend. Most of the formal sector would want to see, what is that? India traditionally has been looking more at collateral that can be provided rather than cash flows. But as that evolves, as the Indian system has evolved from the collateral based, what do people have that you can take back? It's so inefficient to dispose that off for a bank to repossess. All of that is huge inefficiency in the economy. To shift to actually what is the revenue, what is the track record, to shift to more the credit scoring model rather than the asset-based model is also a shift that was happening in India. Now, the informal nature of the Indian economy. And, just about a year ago, I was sitting in a room with some of the top economists in this country just after COVID had begun. And the range of estimates, between what they felt was a formal percentage of the Indian economy and what was the informal portion of the Indian economy. That range varied by 4,000 basis points. So it was a massive, massive difference between what we believe. And we are so closely looking at these GDP numbers and growth numbers, but this massive number of how much is formal and how much is informal itself was, fairly challenging. But we do have some metrics. The metrics that we have is that we know how many tax returns are getting filed. We know how many businesses are registered and are filing their financials, overall, are part of the various networks. And from a very broad perspective, when we look at, what the financial system had to work with, it was a tiny portion of the overall economy. Less than 5% of individuals in this country file tax returns. And about 5 or 6 years ago, or I would say 7 years ago, it was half that. And the majority of those people filing tax returns are filing it to actually get back taxes because of the TDS that's deducted at source. So we know that the system, even today, has a long way to go. But with that limited access to data, with the limited access to what is going on, was a definite sort of hurdle for the financial system to grow at a healthy pace. And the ones that did grow, the large enterprise that did grow, I think we're all familiar with what that did in the manner in which we planned on the data. We had a lot of bad debt that came from them, high concentration risk from the banking system to large companies. And so that was the second sort of big factor. So we talked about two factors. The first that we talked about was the overall lack of scale. The second one, scale resulting in low competitiveness globally. So, imports being much more competitive than our domestic production, as well as the ability to export. So it impacted us in many ways, put pressure on margins in India because of our inefficiencies. And then the second one was the lack of formalization in the Indian economy that was putting a natural sort of hurdle on what credit could grow at. So the government of India has at least laid some pretty tremendous foundations for both of those factors to help this Indian economy evolve on those two factors. You've seen in the past couple of years, the definition of an MSME, people had an incentive, to stay small and within these limits, redefined by an order of magnitude just last year. So now it's 10 times larger than for micro, for small, for medium. All of those definitions completely redefined, so that automatically some of the advantages that come from being defined such, whether it's access to credit, whether it's compliance, all of that. You saw the labor laws get redefined. So, highly simplified, trying to get people now to be able to scale without fearing. I know people that had started 10 companies earlier to keep each one under scale. But imagine an exporter with 10 different companies in 10 different locations relative to someone in Bangladesh, our neighbor, for example, with a single facility at the same scale as 10 Indian facilities. So all these natural sort of barriers, the labor laws could go. A big effort in the past 18 months to reduce the regulation and compliance burden as you get larger. So overall simplification. We also watched something that was very unique and very timely, which is as during the pandemic, we watched the risks of having very high concentration in a single economy for the entire world. Without anybody noticing, in the past 15 years, we had a single economy become 60% of the overall global production in certain, very core categories, whether we are talking about steel, whether we are talking about aluminum, whether we're talking about APIs, so pharmaceuticals. So that not, when you have a, sudden shock to the global system, the amount of risk that got exposed was very high. So the world automatically started to think about diversifying a lot of the supply chain. They became aware of what was going on in terms of the risks that are posed by having such high concentration in a single economy. And when they tried to diversify, we saw that at that point of time, the Indian economy was not as competitive as it should be. Now, while the gap from the past 5 to 6 years, you would have seen we have been trying to close. One is we've started looking at the scale issue, but it'll take time for these MSMEs to grow up and scale to their natural size of competitiveness. While we have invested huge amounts in infrastructure that you have seen, the pace of roads has increased multifold, the airports are being upgraded, the dedicated freight corridors have accelerated. We've been doing a lot. It's not where some of our competitors already are in terms of times and logistics, the compliance, regulatory, all of that we're working on. So the government of India decided to step in at this opportune time when actual shifting was happening. 3 years would be too late for us to be doing that, to incentivize producers, both domestic and foreign producers, to produce in India with what they call the production linked incentive scheme. So the PLI in 13 different sectors was one tool by which we said that we have to be figuring out how to get investment in, but also at a time when the overall global value chain was shifting. We really want to help them get in right now. And over time, over 5 years later, as we scale, it might not be that critical. So in the meantime, for a period of time, we'll support these people as long as they start producing in high volume. And once our infrastructure investments and all of the transformations that are happening in the economy, all of the reform that's happening happens, then India would be a competitive economy because you have that massive advantage of a scale as a country, massive and growing fast. So that was the broad thinking of the PLI scheme. So from on the one side of the balance sheet, you've seen that one of the two issues that we talked about, we are talking about building competitively, building scale, taking proactive steps in categories where India has competitive advantage to do that. And that itself, I think, is going to be, start helping with some of the capital formation, because as that money comes through, you'll start seeing that as the scale goes up, the eligibility of the borrower, the quality of the borrower starts going up. And then automatically the access to finance starts getting better. The amount of leverage it can support will get better. And hopefully our cost of credit also starts coming down, which can also support higher debt. Moving to the second side, which is looking at the lack of formalization in the economy. You've seen 2-3 different sort of tools. The one I'll spend the most time on is GST. So you had a changing in the alignment of interests of businesses, which is that earlier, whenever you paid, when you registered for service tax, it was only punitive, which is if you didn't sign up, you didn't have to pay that tax. So you would go ahead, the taxes were cascading with who you bought. The moment we switched to GST for a big chunk of the economy, we've not made that full transition yet, but for where it really matters, those transitions have happened. Suddenly there was an incentive for businesses to sign up and get into the formal network, because the only way they could get reimbursed for the taxes they've already paid was becoming part of the system and having a credit system. So that's had a massive effect on formalization. The number of enterprises that have been entering the system is huge. The number that continue to enter the system is fairly material. So we are watching that process of formalization increase. We are watching a reduction in the cascading of taxes. And we are watching now even the largest bank in this country, which is still the State Bank of India in terms of assets, begin about a year and a half ago, a program of cash flow based lending. And the prospects for that are fairly good. You also have during the pandemic, for all those folks over here that are planning to look at the new frontier of finance, you're watching the neobanks, the fintechs, all of them come forward. And this entire arena is enabled by data, by AI, big data, all of those things that, you're watching the account aggregation networks. You're watching a myriad of business models that are going to become possible in the largest democracy in the world, where the most underserved in terms of credit. You're watching all of that possible because you have the number of tax returns have doubled, number of people in the GST system and formalization have increased. And the last and most, I think, significant one for an economy that is still at 18% of the world average per capita GDP is what I would call the JAM Trinity. And this JAM Trinity, an effort that began, of course, a decade ago, but gathered material momentum as mobile prices came down. Today, you'd be happy to know that a Jan Dhan account, we've had, over 43 crores, over 430 million Jan Dhan accounts opened, which means that a Jan Dhan account is defined as an account opened by someone that did not have access to the banking system before, right, in the household. That number is a massive number that we have attained that. And what that does is that it is beginning to provide the foundations and the trail for a very massive opportunity for increasing access to credit and the private credit in this industry. I'm not saying all of them will get it, but you have seeded the few. Let's say even a 10% success rate is going to be bigger than all enterprises that existed in India not too long ago. All of the credit that existed in India. So that whole JAM Trinity, you'd be happy to know the deposits are continuing to grow. In double digits, very high single digits, right through this downturn. It's giving a different picture from what people believed about the state of the base of the pyramid of this country in terms of finances. And of course, it's also to do with all the other help that the government provided. But what we have done is we have laid the foundations with, for all of this to sort of drive private credit growth in this country. Now, why is private credit growth so important, you'll ask, other than that it is a contributor? But overall cost of credit in the economy, overall cost of finance in the economy is unfortunately driven by what the sovereign is rated at. And India, I'm sorry to say, is right now one of the highest in terms of its sovereign debt to GDP. But the sovereign is forced to invest because there's market failure broadly in so many categories that the government steps in. Just during this pandemic, our debt has risen from, general government debt has risen from 70% of GDP to 90% of GDP. And what that does, it's relative. So it's not, you shouldn't look at it as, really bad and India's done a bad job. It's relative to all other countries in the world. Eventually, the pool of assets that are investing in GSECs very broadly, I know many countries have it all completely domestically held. But very broadly, India's debt has actually gone up less than many of the larger economies. But still, at an absolute basis, having very high debt to GDP results in high cost of capital, and most private credit is referenced to the sovereign. It's BIPs, it's measured as how many basis points higher than the sovereign. And to have low private debt and have very high sovereign debt actually increases the overall cost of capital of the economy. We are at 6% or 6.5% on our 10-year GSEC. China is at 3.25%. Total debt of China is more than double India's. And you look at the reason why. It's because China kept its sovereign debt under control, and it did it through, public corporations, state-controlled corporations, but that's regarded as private debt. So we've got to get smarter about how we actually manage that. We've got to get private credit and private enterprise with the efficiencies that brings. And that brings us to the main core, I think, of the subject that Professor Bharadwaj wanted me to address, which is the strategic disinvestment and asset monetization program. And this program, the biggest reason why these programs have been such a focus. The first, of course, is to do with bringing efficiencies. The pace of decision making within the public corporation, because of being part of the government, is much slower. Due process has to be followed. Risk taking, as you've seen with the banks as well as with a lot of the corporations, is discouraged within the government system. And a decision was made by this government to actually accelerate previous trends by the new public sector enterprise policy, where the vast majority of the economy was declared to be outside of strategic, and even within the strategic areas. We said that we're going to only keep the bare minimum. So this move towards privatizing, it's not driven, some people might think it's driven by the sort of fiscal side, by the, non-tax revenue that the government will get, but it's not driven by that. This is more of the thinking on how do we grow the pie? How do we get efficiencies, remove the distortions, make the economy grow faster, not have the private sector compete against a government agency which can lose money for many years. So it distorts the marketplace. And we are looking at a lot of that strategic disinvestment, saying that the government's capital, people look at the cost of capital as that 6% the government is paying, but no, that capital's actual return on the market would be in double digits if that capital was given to the private sector. You just have to look at the stock markets to see that, the private bond markets to see that. That's a true loss to this nation by those assets staying with the government, especially some assets where on the balance sheet it might seem like these companies are 20 or 30,000 crores. But for example, a large public sector corporation started in the 50s or 60s, like BHEL, on their balance sheet, you will see that the assets that are held at a price of 5 or 10 crores in Hardwar, the market value might be 10 or 20,000 crores because they're still held at book value. So massive sort of assets that are not as efficient as they can be. So now the strategic disinvestment, which is shifting out of the actual operations of these areas, was what drove the strategic disinvestment. Asset monetization, which is the program that we just saw more recently, was driven by a different factor, which is was a factor that's saying, okay, these are areas where there is market failure, where investment is not happening fast enough by the private sector, whether you're looking at hydro projects, all of that, because the risks are so high, the kind of capital required are so high, they're in greenfield projects. And India, as a democracy, very difficult to do things as unilaterally as in China. You have the judiciary that steps in, you have, the National Green Tribunal that can step in, the permissions, you can have other litigation that can happen. So you have lots of factors why project risk of greenfield India would command a much higher premium from investors. The hurdle rates, for project finance than in many other countries. So to deal with this, we said, okay, the government has to be staying in these areas. But what we can do is that after the project is over and you have a stabilized asset, the government is not necessarily the most efficient operator. So these assets that are there on the government's balance sheet or the public enterprises balance sheets can go to the private sector, to the highest bidder as concessions that will manage it better and faster because of the interest of the efficiencies that come, the faster decision making that will come. And the cost of capital for these is actually going to be, that is going to be demanded. The return is much lower because there's no project risk. The massive project risk of doing business in India. And that's what, we took the opportunity, within the pandemic, the slowdown, etc., to start accelerating that. Because what preceded the pandemic was another huge initiative of the government to meet some of those competitiveness gaps, which is what we call the National Infrastructure Pipeline. That National Infrastructure Pipeline itself, you'll see for the first time in the history of this country, we actually defined by the three sectors what the composition of investment that was required, how it was going to be met. So it was what I would call, why it was so material was historically, we just knew the vast majority of the investment in infrastructure was done at the state level. The center was next and private sector was negligible. Over here, you actually had 40% now with the states, approximately 40% with the center. I know it's 39, 41, but let's just look at it as 40 and 40. So massive increase from the center. And we had private sector intended participation of 20%. So this new way of looking at it, this is what the goal is. This is the government of India saying that we want this greater private sector participation. We want great central participation, and the states are going to be helped because eventually, a lot of the projects at the state are going to be assisted by all of this because we need to improve this infrastructure in as quick a period of time and where the financing will come from. Fortuitously, we had that template already in 2019, December, when the pandemic struck shortly later. And then the asset monetization pipeline that we came up with, which are the areas, what is the menu? Investors come asking questions, what is the menu that we can provide in the areas and the kind of capital that we can get that can speed up the process. So that was the broad thinking behind both of those, that now the operating of these assets will be far more efficient in the private sector. And then the government shouldn't actually be there in number of those non-strategic sectors. And the intention is, of course, to see this massive sort of shift and greater private sector participation. But to do that, we also got to make sure that the private sector is making enough money to be able to get the leverage to take over these assets, bid for these assets. So overall, you would have seen the Prime Minister in the past 18 months make many statements about how private capital and the entrepreneur should be encouraged rather than discouraged. And the amount of compliance and regulatory burden, we have been working systematically on trying to bring it down to make this country a far more efficient country, grow our finances, and help finance, to help the economy grow. So that's the foundation, and I expect that acceleration. I think I'm done with my time, Ashish, so I'll stop there and see if there are any questions.
Thank you so much for that compelling and comprehensive background and context to what we've been doing, what the government has been doing last few months, last few years, for that matter. There is one question that I want to ask, which has come in just now. And since we are running a bit behind schedule, after you respond to that, Mr. Pai, I'll introduce the panel and kick off the panel discussion. The question is, it's actually taking a step back from where you've left us. And there's a fundamental question to be asked. Why have these assets been so poorly managed? And I don't mean to get into the politics of it, because if it's because of leadership issues or some kind of personnel related issues in public sector enterprises or any other structural systematic shortcomings that the government is trying to deal with, then we would like to hear about it. And there's a very interesting example of GAIL pipelines. I mean, they're highly underutilized. Everyone knows that. And it's not because it's an inefficient enterprise per se. It's because of a large number of structural issues that may not be fixed in this with the transfer or monetization plan. So what are your thoughts? Why are we in this conundrum right now?
First, I'd like to just provide a qualification that I speak for myself and not for either the government of India or for NITI Aayog, and in my personal capacity, not my professional capacity in answering that question. The most important thing I think that I see is the speed of decision making. The overall Indian economy has started moving much faster, and not just the Indian economy, but the global economy. Things are happening much faster. You look at the unicorns; you're watching, folks 3 years out of school developing billion-dollar enterprises very quickly. So we know that things are changing much faster than they did historically. And the government, by its very nature, not restricted to India but globally, has follows due process to make sure things are fair. There's no currying of favor. There is no vested interest. Follows a due process that is fairly excruciating. And in India, I would say that we are particularly conservative and that bent of mind. As a professor of finance, also, I think that you will fully recognize that risk and return are positively correlated very broadly. So if there's a big chunk of the economy that doesn't want to take risk, and that same chunk of the economy has extremely slow decision-making process because you can't take the risk of the board decision and within 3 months make massive changes, goes through, I don't want to describe the entire process. I'm sure most of you know, but it's a fairly tedious process that goes through many checks and balances. It's more about checks and balances than taking risk. It is avoiding and mitigating risk. So that's the way, I think that's the principal reason why, things over here are going slower. I would also beg to, sort of defer on definition of efficiencies when we measure it, right? So the example that you used, for example, was GAIL, which is a gas pipeline company. Now, most people would look at efficiency in terms of measuring the output per person or profitability, etc. But that might not be the right metric, right? We've got to look at, how should we measure the efficiency of some of these organizations, because in the same sentence that you talked about, GAIL being an efficient organization, you also talked about utilization of its pipelines. So we've got to see how to measure that. In a public sector corporation with multiple mandates, there is clearly going to be a hit on efficiency. And the hit on efficiency is because just production is not as important as the impact that production will have. One of the reasons why these are in the public sector is because there is market failure where the market is not clearing certain sectors, and especially in areas you're looking at. Now, in GAIL, in particular, there was a conflict between two separate alignments that were necessary. So one is the marketing side of the gas itself, being the owner, the buyer, the trader of the gas, and second is the pipeline. And what that does is it creates a conflict. If you own the pipeline and you have your own gas, even the company that is independent, just for sake of using names, whether it's a BP or whether it's a Reliance or anyone else that is going to be accessing that same pipeline. In their minds, they think that at any time where there's huge demand and it's full, the pipeline, even if it's not full today, who's going to get knocked off in their ability to send gas if that party is actually competing, with them in that business? So it owns both the asset as well as the business. One of the reasons why an airport is not allowed to be majority owned or controlled by a certain airline in most countries is to avoid that same issue, is to give an unfair advantage, because automatically you've created, an agency, cost over there. Now, even if both stay within the public sector, for whatever reasons, strategic and GAIL, there is a move to divide GAIL into a pipeline company and a separate company, because the moment it's arm's length, the profitability separate, all of that, you don't believe you're subsidizing your competitor. You also believe that you'll have a better chance of getting equal access with your gas getting preferred the same way. Decisions being made not for selfish return on their own balance sheet for their own assets on where they are, but on the basis of maximizing profit. And then it's a more competitive environment for the 4 or 5 other gas. So that's what I was referring to when we look at that efficiency and that capital. I hope I addressed both your questions.
Yes, you very well did. Thank you very much. Well, the idea of creating these structural partnerships between public and the private sector to really unlock value from some of these assets in the public sphere, recycling revenues that are raised into new infrastructure, new investments, that makes imminent sense. And with this, I want to now congratulate all the viewers. You have unlocked the second segment of this session, which is a panel discussion. Now I'd like to invite the other speakers. We have Dr. Manoranjan Pattanayak, Executive Director, Economics and Public Policy at PwC India. We have Saloni, Jhaveri, who heads the investor relations and partnerships at the National Investment and Infrastructure Fund, and my own colleague, Professor Rajeev Malhotra, a professor and executive director of Center for Development and Finance at the School of Government and Public Policy at Jindal. Thank you very much for joining. What I'm going to do is to skip my own opening remarks because all of us want to hear from you more. So let's dive into some of the things that Mr. Pai shared just a while back. Rajiv, I want to start with you. You've worked actively with the finance ministry of previous governments. Of course, the term PPP and its numerous avatars are not new to you at all. It's how does it sound to you, the plan that has been laid out by the government and articulated very well by Mr. Pai? How is it different from what was done in the previous 2 decades, and how do you see its potential?
Right. Thank you, Ashish, for having me here this morning. Though I come at a very short notice, so I guess I'm less well prepared than the other panelists. But let me go straight into your question. I think, and let me just focus on the whole plan the current government has ushered in terms of monetizing the public assets. And I think to begin with, it's a step in the right direction. And I would say that it was inevitable. And why do I say that it was inevitable? I feel, without going at this stage into the background, we will see how the discussion pans out, and maybe I'll come back to that later. But I would say that the appetite for greenfield investments by the private sector has gone down steeply. Why it has gone down? And I would look at both economic factors and more importantly, the non-economic factors, which may have compromised the context and brought more uncertainties and increased the risk element to investments. So my submission is that it was inevitable because private sector has lost appetite for greenfield investments. So the only way to kickstart, and Mr. Pai was right. I mean, we need to get the private investment moving, which unfortunately has been in a declining for over now. Almost the pace has been declining for over 10, 12 years. It grew in the high growth phase, the first decade of this millennium, at about 15 to 17% per annum. It is down to 6, 7, and even lower than that in the most recent years. So the fact that you need to kickstart private investment, you need to provide options for the private players, investors to get going. It was inevitable that one looked at this path of monetizing existing public assets. So I would say that it's a step in the right direction. There would be more demand for brownfield investments than for greenfield, and so it is. The other part of this is, although we may not admit it, and even Mr. Pai went to the extent of saying that, there is a fiscal bottom line question as well, which governs this decision. But on the whole, it's a step in the right direction, and we need to take it forward. But the catch is that for this to succeed, and you alluded to it in your brief remark, that there are these other factors, the contingent environmental factors that need to be addressed. Take, for example, the question of the highways, the road sector. Why did the PP model took time to get going in that sector? While we did answer and we did resolve some of the primary concerns there, but some of the contingent regulatory concerns were not addressed. Land acquisition was a major problem. Take, for example, the case of the peripheral highways, Delhi, the Eastern Peripheral and Western Peripheral Highway. Just because a stretch of 2 kilometers, the land required for that was not acquired in time, the whole Western Peripheral Highway was languishing for years. So what I'm trying to say here is this step to encourage brownfield investments through monetization of public sector can succeed only when these contingent issues are also addressed. If we fail to do that, we are not going to see the revival of the private investment anytime soon. Let me just stop here, and maybe I would like at some point to also dwell on the background that needs to be seen in the perspective when we analyze these decisions.
Right. Thank you for those comments, Rajeev. I want to bring in Saloni Jhaveri now. Saloni, the same question to you. What is your reaction to this new vision that has been brought to us to revive the economy, to bring in the private sector into the infrastructure and in other areas as well? And when you respond to it, could you also share with us some examples of successful programs like these globally based on the work you do? Saloni.
Absolutely, Professor. Thank you. It's a pleasure being here, and thank you for giving me the opportunity. So obviously, infrastructure is a key priority for the country. It's actually a key priority for most countries, right? Today, while you have headlines of all the technology companies, but today in your daily life, from when you wake up, and brush your teeth, where you need the water, where you need your Wi-Fi, where you need to get into a car and go somewhere, infrastructure is something that touches each of us in our daily lives. The big question, though, is really, and for all governments, I don't think this is only for India, it's how do you finance this infrastructure development? Greenfield infrastructure around the world has been challenging. India has faced its challenges, but it's not only specific to India. Long-term investors, where large pools of capital actually sit, which is pension funds, sovereign funds, they have always preferred to invest in operating assets because the risk reward for them doesn't work in field infrastructure. In India specifically, if you look at what happened in 2000, we did in the late 95, post 95 to 2000, 2003, there was significant investment that went into greenfield infrastructure, almost I think $200 or $300 billion. But that, unfortunately, through private-public partnerships, but the investors did not really get the returns that they had anticipated. There were a couple of reasons for that. One big reason was there was a little bit of a misalignment of interest, as we see it. EPC contractors have become developers, and their core business is contracting. The development mindset is quite different, and financial investors who had actually backed these, at that point of time, there were challenges in terms of what really happened, and I think that's one of the reasons why private investments has dried up in the greenfield sector. Of course, other reasons we've all alluded to, and we're all aware of: land acquisitions, delay in approvals, all of that. But that, I think, is sort of inherent in most greenfield projects. Now, the question really is today is, where do we go from here, right? What is it that, because now it is, as everybody has said, private investments really has dried up. And I think the realization for the government also is that now the cost for greenfield development really has to be borne by the government, because that's really the risk return where that works perfectly well. So one of the structures that they've thought about is, asset monetizations, and it has been globally successful. It's basically recycle the capital from operating assets to build new assets. Now, one big advantage, and Mr. Pai also alluded to, the efficiency. The end user, in many cases where we've seen these assets go into private hands, the experience to the end user and the customer has also significantly improved. And today, just digressing a bit, today, where are the two big infrastructure programs that are ongoing globally? One is India, one is the US. India is around $1.5 trillion. The US is around $1 trillion. But that's truly where the similarity ends. How is the US thinking of financing it versus India? The US is thinking of financing it is by increasing taxes, which is one thing that every government can do. The second, the way India is thinking about it is really through its budget deficit, and then doing asset monetizations to really then, fill in the gap again of what that deficit creates. And many countries, the government has also realized that, asset monetization is a good solution, but they've realized that there are many different structures that can be brought to the market to really attract a wider set of investors. So today you have InvITs. Investors, if you want to invest in an InvIT, investors who are looking for stable long-term returns, yield type returns, that's where they would go to. Then you have TOTs, which is the toll operate transfers, the roads that have been given for TOT. That is for investors who are more active, who want to actually operate, manage them, and take long-term, do long-term concessions. That's and there are a number of investors who are interested in those type of models. Then there's of course NIIF itself, which is an innovative product that the government has come out with, which is a partnership-based product where you actually are partnering with investors across different asset classes. Then you also have the airport privatizations, again on a long-term concession. So these various different structures, and if you look at India, India is one of the one emerging market, I think, that has the largest stock of revenue generating assets. It's a huge pipeline, which other emerging markets really don't have this. So there's significant interest in a lot of in investors for this type of assets. Where you told me, what is happening globally, I think this is a model that's been used very successfully in Australia. Brazil also has done a lot of privatizations and monetization successfully. But if you look at the Australian model, which happened around 2015, 2010, between 2010 and 15, 16, they started this. The central government basically incentivized the state government. So they monetized the assets, and almost 15% of the proceeds went back. An additional 15% of the proceeds was given back to the state governments if the state governments use those proceeds to develop greenfield assets. So it became a virtuous cycle of asset monetization and asset development. And I think that's really an area, and I think that's what the government itself is trying to do over here, with involving the state governments as well as the central, as well along with the central government. Now for this, but there are a couple of things you have to do, right? You have to ensure consistency of contracts. You have to ensure stability of policy.
Saloni, sorry to interrupt. That's one of the things that we would like to discuss in this panel, of what we need to get right in order to really implement it as it's imagined. We'll come to that. It's a very important point that I'm leaving you with. But I want to quickly come to Dr. Manoranjan Pattanayak with broadly the same starting question. You've heard the different speakers, Manu. You've heard that it's a promising idea. It's a welcome step, as Rajeev says. But there are also certain challenges that we face because of the tax system. There's a certain challenges we face because of the pricing of these products and services, a relationship between state and center. There are many things and a lot of positives as well. Where do you stand? What's your view?
Hi. So I think it is right move in the right direction. Of course, Ajit has highlighted that the primary objective is not to garner capital or to fund the deficit. It's to enhance efficiency, and it's well recognized that the private sector operates in a more efficient mode. I think that in all the public debate, all the intellectuals, they do always talk about that private mode of operation is more efficient, and that's the right direction to go. In fact, government has also shown the right intention, that withdrawing from a lot many sectors and only retaining a few strategic sectors. And I think this asset monetization, I would also like to believe that the primary objective is not to get the capital only. It's to enhance the efficiency of the assets. In terms of the feasibility, that national monetization plan, that 6 trillion that government intends to collect, I think over the period of next 4 years, I think where the most of the debate should happen, that what should be the trajectory of making it possible. So I think we have passed the stage that whether we need to do or whether it's the right thing to do is over. Uh, I think the NMP and the NIP are intrinsically related, though, right? The National Infrastructure Pipeline and the National Monetization Pipeline. I think that they're very, very closely related. Ajit highlighted in his talk that India has improved its per capita income in the world in terms of the world share, I think, over a period of time. But despite the size of the overall economy, if we just look at the mere per capita income terms, India is still, 145th or 146th rank, right? So we have a long way to go. And there's no doubt that the infrastructure, the massive investment in the infrastructure is the right way to go. I think the national infrastructure pipeline, maybe Saloni can talk more about it, but that 111 trillion that is targeted, I do not know even if that is sufficient. If we have to enhance our productivity, efficiency, and enhance our per capita income. But I would like to say that it's the right way to go. The only thing we need to discuss that how we should make it efficiently, and the market should be. It should not lead to a situation of a monopoly or oligopoly or duopoly kind of situation where few large players are, getting all the assets. I think that is one of the concern. The other concern is that maybe only the good assets would be auctioned, or the private parties will acquire the good assets, and the lemon should be left. I think those are the points where we need to all discuss and find a way out. I'll stop here.
Thank you. It's a very important thing that you just mentioned, Manu, and I want to take it directly straight away to Mr. Pai. One issue that may hamper the projected overall efficiency gains is a possibility of monopolization, and then its subsequent impact on competition, of course, and then on consumer welfare. So the question to you is, could this process induce, as Manu was saying, some kind of concentration of market power, or at least that's what he hinted towards, that could have possibly serious anti-competitive implications?
I think it's a very, very interesting question that you're asking right now. And this is a question where, when I look at the manner in which our Competition Commission has functioned in India, and the manner in which I think we need to change the way we think about this entire area, is that the world has become a far more global place. When you look at competition at a local level and you're trying to keep your structure of industry in a manner that you're going to be very local, you actually might become uncompetitive at a global level. Our problem in India has been too much fragmentation recently. Now, until the 60s, I would agree. When you look at the 40s to the 60s, you saw massive growth in terms of, India. When we set up an infrastructure, we had the license Raj. But very clearly, that started becoming counterproductive after the 60s, once that capital had already formed. Highly counterproductive, and what Maruti Suzuki did to the car industry, where we only had a choice of two real cars, was massive. And the same in the telecom industry. We have so many of these examples in our mind. But the world has changed and moved from there. And when we look at capital formation today, right, we've got to look at it in a very, very different way. When you're looking at Korea, with 3 players controlling an entire industry, where in India you might have 30,000 players when you look at steel, the majority. That makes them competitive in terms of scale globally. So if we start looking at competition defined very locally within our economy, we may not be doing full justice to producing global champions in certain sectors. One of the things that the PLI scheme is doing is it is allowing certain players by choice to become much bigger, supported by the government, to become globally competitive. Now, we try to give equal opportunity to the domestic and equal opportunity to the international players, with the PLI, to bring that production base, to bring those economies to India. But in reality, that question now, we have to re-question our antitrust laws. We have to again look at whether a player like an Amazon, which has so much massive global market share, whether their domestic share really matters. Like, even if they come up to whatever share they have over here, when you look at it at the global level, they're so big, so massive, the economies that they get over there. Is there, if you're in 100 countries and you're a 30% player there, is it the same as being 45% in a single country? So a lot of these questions on antitrust have to be revisited. Yeah, sorry, you had a question?
No, just sorry to interrupt. Are you, Ajit, are you trying to hint that we need to take the bitter pill of allowing for concentration of market powers just to ensure that things go well as they're imagined?
What I would say is that when we look at it, we've got to look at it in terms of not just a domestic industry. We have got to expand the horizon on which you measure that market power, because when we want to sign an agreement like RCEP, we would not be competitive in RCEP if we maintain the kind of ratios we have over here at this stage, because we're fairly nascent in many areas of the supply chain, the global manufacturing supply chain. So the perspective should not be a very narrow perspective. We've got to start looking at that global landscape, because trade as a percentage of global GDP has been rising. I mean, not for the past 10 years, since the global financial crisis, it's plateaued and coming down. But there are pockets which are still rising in Southeast Asia. It's still increasing in many places. So we've got to look at that broader canvas. You're not saying bitter pill. Now, to your specific question and what I think Dr. Pattanayak referred to, for example, everyone, in the media, you're saying Ambani, Adani, all of that. In real terms, if you have a look at what happened with airports, the entire volume of the next 5 airports after taking away the 4 metros is less than number 1. So in absolute terms, when you look at it, the efficiencies that any operator, a single airport, single place in a single area would not be competitive. You remember when we had telecom circles and we had 100, none of them would be effective. So to give the number 4 player that is coming in as a new entrant, to give him scale in terms of 5 airports, you add them all up and it doesn't. People look at it and say, but he was aggressive only because he was going to get a certain number of these airports together. And even then he can't simulate the economies. What happened with Mumbai subsequently is a different matter. We're just talking about the initial 5 airports that were going. After that, the Mumbai was, that's not what I'm referring to.
I was about to say Mumbai airport, but I'm glad you brought it up. Well, a lot of people say that it's inevitable. The concentration that we're talking about is inevitable in the case of highways or railway lines that are so important for large sections of society. Maybe not so much for warehouses, which are also part of this plan, since all the warehouses need to be sold or leased at the highest bidder anyway. But just for the audience, I want to clarify that Dr. Rajeev Agarwal of NITI Aayog did in fact clarify this a few weeks ago, that the price is going to be regulated and any sort of increases are going to be capped in line with inflation. And that raises another question. Based on the solution which was proposed, that will the private firms that the plan is trying to engage with will be open to this kind of arrangement. I mean, private sector hates price caps of any kind across the spectrum. I want to bring in Rajeev on this point. Rajeev, what do you think? How can the interests of the consumers, what the government is trying to ensure through this plan, and rightly so for all stakeholders, how can this be balanced?
Yes, thank you, Ashish. I think the bottom line is you have to encourage competition. There's no way else to protect the interests of the consumers. Now, Mr. Pai has a point when he referred to the case of the 5 airports. Of course, you need a certain scale for the private players to see it an attractive investment option. But look at what has happened in India since the opening of the economy in 1990s. The only thing that has worked in the favor of consumers is competition. Sectors where competition was allowed to flourish has brought the kind of surplus that we are all enjoying right now. So I have a serious concern if on one hand we are doing what we are doing, and on the other hand we are saying that no, there are going to be regulatory measures put in place. It would make the whole investment proposal for the private sector less attractive. So I wonder what their kind of response would be going forward. And since we are just at the start of this process, I think it is very important to get the ecosystem right. And unless the ecosystem is right, the kind of response that one is anticipating will not happen. We have seen that with the PPP model, and that may well be the case with what we are trying to do with the monetization of public assets if we do not look at the larger ecosystem issue. For that alone will attract more and more private players to come into this.
Thank you. Thanks, Rajeev. I want to push this point a little bit more. I want to go to Saloni now. Saloni, we've been talking about what can go wrong, how well is it planned, how grand an idea it is. But let's get to one specific issue. Who are these investors? What kind of investors would be interested in investing in assets that are being monetized by the government?
Thanks, Professor. Professor, just one more point. I'm going to respond to the point that you asked Rajeev earlier as well, just my take. So I think while in some of these infrastructure assets, when you're giving concessions, I think that cap is required from a consumer protection perspective when you're monetizing. So what investors like ourselves, when we look at investing in these assets and how do we think about making money? So if you look at roads, well, how you would make money is by driving more traffic growth. While your price might be capped, so how you improve efficiency, you improve the quality of the road, you improve safety standards. FASTag has been a big reform that obviously now the leakage has reduced significantly. So many such factors that you can actually look at when you're taking over the road and then make money even though you have a price cap. The second, even on airports, there's a lot of non-aero revenues. So how do you drive non-aero revenues to make money? So there are many models when you take over an asset from a private, privately and make money. It's just not the one number. And having said that, for investors, what's important is the stability. So as long as they know that these are the assumptions they're underwriting, it's fine. What is difficult is when you have to your assumptions change midway after you've taken over the asset, and there are changes then. But from the start, if you know these are the numbers, then that's how you underwrite your investments. Coming back to your specific question, so today you have actually some of the largest investors, pension funds, sovereign funds, who are extremely interested in acquiring operating assets, and for them investing at scale becomes critical. $200 million, $300 million are check sizes. For them, doing a 50 million check size is just not efficient enough. So you're looking at large monetizations. And why is that? Because this sort of gives them some sort of stability and long-term yield. Infrastructure for global investors, the reason they invest in infrastructure is to sort of balance out the rest of their portfolio. This gives them infrastructure is sort of a hedge from that perspective. It's yield-based assets. It's a little bit monopolistic, so there is stability in revenues, and that's why most of these investors are investing in infrastructure. So if you look at the top, you pretty much look at the Canadians, the Australians, pension funds. Almost from their allocations, a good 10-12% is allocated to infrastructure. Others, if you look at US pension funds, around 5%, but in terms of actual dollar numbers, those are yet huge, because these funds are like, $100 billion, $150 billion and growing significantly. And I'm talking about average size. I mean, like an RDI is, of course, $500 billion plus, that kind of stuff. So these are the type of investors that are very, very keen on investing in India on these monetization opportunities.
Thank you, Saloni. I have to take this to Ajit. I know he would like to respond to that, but very quickly, Manu, what would be your response to what Saloni just said? That there are very specific kinds of investors who, based on the global experience, who would be interested in this, and that links with a certain kind of perception some people have that the truly battle-hardened domestic entrepreneurs might get crowded out. by, as Saloni was saying, the global pension funds, sovereign funds, which have this tendency to focus only on yield-based, sort of monopolistic manner of approaching it. Do you think that's a problem?
Sorry, yeah. So, first I would like to respond on the price cap point you raised in the earlier, discussion. Well, so this whole national monetization plan, I do not think it is going to change the structure of the industry, right? You are not doing, you are merely transferring the operational rights, right? The structure, if the industry structure is concentrated, let's say the CR4, the top 4 farms, if their contribution is 60%, 70% to the gross value added or to the total sales, I mean, that is not going to change, right? You are not breaking up the monopolies, or you are not creating smaller units, right? You are merely transferring the ownership rights from public to the private. And given that the private sector operates at much more efficiently than what the government operates, that is the fundamental device, and it's been proven true also in several cases, then I would tend to believe that the price should come down, right? Unless the monopoly rent is so high that the profit motive is so high that they put the price at a very high level. But I don't believe that is going to happen. Only when the utilities, large utilities, where the natural monopoly kind of element prevails, where the scale economy is very, very essential, only those kind of industries or the setup, maybe few players would tend to dominate, and it's the global experience as well. But I would tend to believe that in large many sectors, there would be too many players. And so far, the participation of who would participate in this, I think that the world is flat. It would be the domestic players, it would be the global players, it would be the sovereign wealth funds, many institutional investors. They would participate, and it's a very, very attractive opportunities for all.
Thank you, Manu. I want to, Mr. Pai, do you want to respond to that? We heard a slightly different view here that the price will really have to come down, and Rajeev was saying the competition will have to be induced at some point. How would you react to that?
So, I mean, there's so many things to respond to and what the 3 other panelists have just said. So let me try and address them one by one. So let me first take a little bit from what I think Saloni just said. And, in what she had said, she did sort of allude to the fact that some of these infrastructure assets are natural monopolies, right? And so that is one other thing that sort of addresses that anti-competitive question, very broadly. The media and everyone is focused on 5 airports or whatever, even though the volume might be small. But at a fundamental level, each airport is a monopoly, and it's a state monopoly. Each road is a monopoly, because you're linking up 2 cities, you're not going to have a competing road. So Saloni is absolutely right. When you have all these monopolies, the regulatory aspect is very important. Now the question is that what is that right level? How does the regulator operate? Is India actually the regulatory environment, the suitable regulatory environment? And that's a whole different question. And that question, I think, when you look at the classic composition of a regulator, it is prior bureaucrats, it is a few other people. It is very much set in the way that the government system is done. And there are lots of reform that can happen there, but we're not going to touch that right now, because that is not the weakest link. Today, the regulatory environment is not the weakest link, it would be my prayer. And what I would say is that we do think about competition wrong, but I've not criticized the CCI because it's not CCI's fault, right? So when you look at telecom, for example, it is so complex. You're looking at an industry that we try to fragment it, we try to create competition at a local level, but there are no efficiencies there at a global level. We are now over-consolidated there. But what drove a lot of the consolidation was a disruptive new player that priced at negative incremental cash flow, drove a lot of consolidation in the others to a structure that very clearly is not favorable for the Indian public. Now, just price in the short run. I mean, the first antitrust law in the world, when you look at the Sherman Act of the 1860s, you're looking at, against Standard Oil, It was because he was pricing too low to bankrupt his competitors locally and not standardizing it. So what happened in the telecom industry was also pricing like that. So pricing is a very, very delicate subject. Public good just being lower prices, it depends on the duration of those lower prices. It's not just the short run. I would argue that what happened in telecom, the current structure is not healthy for India, right? It is too highly concentrated, but it happened by someone charging below. It didn't happen by regulatory intervention and, price constraints. So we've got to think about this. Our institutions have to transform, all of them, and they are evolving. I'm not saying that they're static. The question in India that, the reason why I was measuring India's per capita GDP relative to world average is because we all look at our absolute growth and the progress we have made, all that, but you have to look at a relative basis. We need to be transforming faster. We need to be adjusting faster. But the issues that have been brought up on price, regulatory, recognizing that each one of these infrastructure assets is actually a monopoly, whether it's a GAIL pipeline you talked about or others. It doesn't make sense for a poor country at our per capita GDP to have two gas pipelines, to have two airports next to each other when the level of penetration efficiencies are not there. So we've got to think about the competition and that question, right? I hope I'm I addressed that question and sort of touched upon what all three of the speakers have done. But pricing control is important in a monopoly. I think we should all agree. And the method of bidding for these airports is very different. It's been actually how much that concessionaire is going to pay you. The other slight correction is that the assets are not transferring to the new owner. Like the ownership is not transferring, as I mentioned. Only the concession is for a period of time, just to clarify that, what Dr. Pattanayak said. It's not the ownership that changes. It is for a period of time it goes there, and what's great is it reverts back in these asset monetization exercises, back to the government at the end of that concession period. So any sort of inefficiency now has been, minimized rather than in strategic disinvestment when the whole asset is gone. With asset monetization, it reverts back to the organization. So it can be bid out again, any disconnects over time, differences in inflation, whatever that will sort of renormalize. I'll stop over there. Thank you.
Thanks. I'll give an opportunity if anyone wants to. Yes, please go ahead.
Just Ajit, I mentioned that only the operational rights for specific period would be transferred. It is not the ownership rights. That is what I was trying to distinguish. That in terms of industry structure, I think the industry structure is not going to change. Probably the ownership structure, maybe for the temporary operational right. In that way, I was trying to define it. Certainly, it is not outright privatization or the disinvestment.
Okay. Thank you very much. We still have about 5-7 minutes to go before I bring in questions from the audience, and they've started to come in. I want to go back to Rajeev now and hopefully not push the conversation around pricing and consumer welfare beyond that. Rajeev, a very important stakeholder in this entire discussion about national assets, public enterprises, public goods remains the end consumer, really. And after all, the leased assets were created through significant tax revenues from the public. What do you think are the kind of, based on the experience you've had of dealing with a PPP kind of model earlier, what kind of additional benefits can citizens expect to receive? And I'm approaching this question from what Mr. Pai just touched on, from a very public interest driven public good approach vis-a-vis a profit driven private good approach. We need both.
So let me start by saying that what is it that the average citizen is looking for? An average citizen wants assured supply of and good quality public goods. And if this modality allows the space for meeting that demand, citizens should be happy. So the question is, the resources released through this act, where are they deployed, and how is that part of activity handled in the government, in the public domain? So citizen is ultimately wanting good infrastructure because aspirations have gone up. Opening up of the economy over the last 30 years have raised aspirations, and they are willing to pay for whatever they require provided it is assured and supply is maintained. So that's the interest of the citizen. The question is, will this modality create the space for meeting that requirement? And that goes across not just physical infrastructure, but also social infrastructure. Look at the state of affairs on the social side. And I hate to say this, I studied in Delhi University, but the number of seats for students to get admitted there haven't changed over the last 30 years, over the last 40 years. So there are these gaps, and we have to find ways to plug these gaps. Is this modality going to help us? Yes, perhaps it would. But unless we get certain other contingent things going in the right direction, I have a fear that we may not have as significant results to see, much like the way we with our initial experiments of trying to encourage greenfield investments through PPP models and so on and so forth. But let me also reiterate that this step is vital, because we need to do something to infuse the animal spirits back in the private sector. And so big ticket items like disinvestment of Air India or disinvestment of a few clutches of public sector banks may set the tone going back with the private players, and I'm not too much worried about the kind of flow of capital that we need to target, whether it is from sovereign investment funds or from the private side. I think there is enough money here in the country. Look at what has happened in the last 3, 4, 5 decades. Mr. Pai started off by saying that our saving rates are not high. Yes, if you compare it with China, certainly not. And the problem with our saving rates have been that it is skewed against financial savings, which is changing rapidly. And at least that's what we have seen in the last 3, 4 years. So that's a good sign. But my bottom line is that don't worry too much about resources. The resources will come. Get the ecosystem right. And while taking these big ticket steps, you need to be conscious of the smaller ones, which have the potential of derailing the results that we are anticipating from these. This is the lessons from the first decade, and these are the lessons that we need to take very seriously as we go forward post-pandemic.
Thank you, Rajeev. I could see Mr. Pai nodding when you said we need to unleash animal spirits among the private sector participants. So this is a good opportunity for us to now open the panel to audience questions. They are really open questions to all the panelists, so please feel free to respond to them if you have a comment on it. The first one is, let me contextualize it. The success of the NMP is dependent on the actual designing of long-term concessional agreements to prevent needless litigation and friction due to any kind of unforeseen circumstances. I mean, for example, climate change, something that we are going to be discussing later in the day. And we all know, we've seen what happened earlier this year, dispute resolution can become really tedious. So the question is, how will we ensure efficient contract design and dispute resolution mechanisms, both of which are terribly complex legal processes in this plan? Who would like to take that up? No one's unmuting. That's not nice. I'll add one more thing to that. There were recommendations of the Kelkar committee about 15 years ago of some kind of an infrastructure PPP adjudication tribunal to kind of suitably set up a specialized dispute resolution capacity, particularly for this. You think now would be a time to go deeper into that?
So let me take a stab. I can see the general reluctance, and even I would be reluctant, because this is an area that I would say that historically, when we're coming to a new area with limited success, that we're trying to push very hard. So as a huge proponent of PPP, what I would say is that the system's incentives have been aligned against it. There are too many stakeholders with vested interests that want PPP to fail, whereas we all know that collectively the PPP is probably the most effective way for India to move forward. But there is a traditional whole bent for EPC for other kinds of contracts because of the manner in which people are incented, of the way the system is set up. Now, there are two tremendous individuals that I want to just mention over here. There's a gentleman that used to be at the Planning Commission and been elsewhere previously by the name of Gajendra Haldia, that did tremendous work in, a bureaucrat that did tremendous work in writing these PPP documents. Because, the point that, what you referred to, Professor Bharadwaj was the resolution side. But if the work up front is done, if all our regulations in this country were highly simplified, that we didn't have an Indian penal code from the 19th century still sort of out there, I think the number of cases and disputes would get fewer if things are written better up front. So rather than look at the solution side, let's do the preventive side, So a lot of that work that has been done by people like that needs to be taken forward. We have to recognize that the system is set up to make PPP fail. Everybody over there wants it to fail, whereas collectively it is in our common benefit to make sure it happens. And so the examples of failure will keep coming because people don't want it to succeed. And I look at that, it is so perplexing to me that the system is so, everyone you speak within the ecosystem that has been in the previous mode doesn't want it to succeed. It's exactly like the faceless income tax. Everyone within the system doesn't want it to succeed. So we've got to figure out a way that it can improve, that there are enough officers within the system that have the right mind frame that want it to succeed. And as anything that is nascent, you're going to have your teething problems. You've got to ensure they get better and better. We've got to ensure it gets fairer and fairer. We've got to learn from our mistakes and make sure that it evolves much faster. So I know I've probably spoken more than I should have on in this particular subject. Again, the views are purely personal, not representing the government's view, definitely not the NITI Aayog's view. But there's a tremendous amount of work we are doing here as NITI Aayog. We have officers that have gone in, SK Sahu, we lost recently, but also tremendous work on PPP, and we're trying to improve it. We're trying to sort those problems out as quickly as I can with any of the stakeholders, any line ministries, with any of the agencies. We're working on it, but there's a long way to go before it gets, to where we want it to get.
Well, thank you for that candid response, and we wish the Aayog and everyone who's involved in this massive project all the best with it. There's another question that has come in, although I feel it's slightly, it's water under the bridge at this point, but it's always wise to kind of under-promise and over-deliver, generally speaking. But the question is, do you think the government could have started with the sectors that would have offered the greatest cash flow predictability before expanding the experiment to cover all the other kinds of infra that the plan has now? Anyone can take it, maybe starting with Mr. Pai.
Let me come in here, Ashish.
Sure.
I think this is a very, very important point which has finally come. The success of any policy really depends on how credibly it is seen by the stakeholders. And I think on that count, we have a lot of gap to bridge. If you look at the last 15 years, many announcements have actually not fructified. And that adds to the skepticism among the stakeholders who need to respond to these policies. So I kind of actually am of the view that it is sometimes easy to, good to promise less, deliver on it, and then build it up, ramp it up as people start getting into the move, which doesn't seem to be the way this government sometimes looks at things. And so I would have liked, rather than floating these big ideas, sometimes perhaps Mr. Pai may disagree with me, in a half-baked manner, then doing a good groundwork and then taking smaller steps, more credible smaller steps to create and strengthen the larger ecosystem that I have been trying to allude to in my earlier interventions.
So I certainly disagree.
After that, Saloni, sorry.
Yeah.
Go ahead, please.
So I certainly do disagree, and there are two reasons for that. The first is that when you're looking at global investors, it's not a single investor; it's thousands of investors. And what we are providing in both of these is actually, I would call it, over a period of 5 years. Each of these are not things that happen overnight; it's over a period of time. Is you're providing a menu. So one of the issues you have if you put three out at the same time. I would also beg to differ that I don't think that we have not done the groundwork. The groundwork is extremely extensive. We are happy to walk, Mr. Malhotra through what went through this process. If he's ever interested, we are happy to go through it. But it was extremely strong diligence to do it. But the way to look at it is the perspective was that we need a menu. When people are coming, if they see 2 or 3 assets, it's of limited interest. When you give them a whole menu and you say this is going to happen not immediately, it's going to happen over a period of 4 to 5 years. What that does is that it says that we have a strategy, we have a plan, this is the big picture. And guess what? As we already talked about the issues in operating in India, you have judicial intervention, you have cases filed, any of these things can get blocked. And in India, what we tend to do is we tend to come and we put in these very low thresholds against which we underperform because there'll be a case somewhere or something or the other. What we really need is we need something that is ambitious, that people can aspire to. And guess what? If you get a consolation prize on an ambitious target, you're still doing much better than having judicial intervention and making excuses on projects that are not even envisaged to meet your 10% growth. So I think that traditional rate of growth of India and the mid-single digits is a function of that thinking that let's not raise these targets high. I also sit on the MOU committees with the DPE, looking at all the public sector corporations, and all they're doing is fighting for lower and lower thresholds that they can outperform against. You look at that absolute performance, it's ridiculous. And then you look at it, all of them want an excellent rating. And I'm saying that you set those targets at a place that are aspirational, which is what we are doing. So do I really expect that all of those things, the national monetization pipeline will happen? Clearly not. But have you provided investors, a pool of global investors, 3,000 global investors? Have we provided them a menu from which they can select and potentially find something that is a better match for what their needs are than putting out 20 assets in a single year and going to all of them? Is it far more efficient? Is it aspirational? So I think that both of these maiden efforts to encapsulate, to put in a structure, to broadly think about where will the capital come from is unprecedented in Indian history. And I'm not politically affiliated in any way, but we've got to change that mindset. We've got to start thinking bigger. We've got to start thinking holistically, and we shouldn't be thinking in terms of small thresholds and walking them, because that's the pace. That's where we're going. A change in 1990, but not sufficiently. We've gone from that 6.5% of the world average to 18%. But there are other countries that started later than us that have surpassed us. Look at Vietnam. Look at so many other countries. Our pace of growth is disappointing. Our performance this past 30 years is disappointing, even since liberalization. We have to accelerate it. And if we want to continue to grow at this pace and set things are very achievable and getting people moving at that pace, then it's not going to do justice to our future generations.
Very well put. Saloni.
Yes.
I'm tempted to respond to what Mr. Pai has said, but I can come back later. Go ahead.
Yes,
Saloni.
please.
Yes, so I think I'm just going to add to what Mr. Pai said. I do think that this is not the government just starting up, right? We've had, if you look at the last decade, we've had forget the 6 privatizations that just happened. We've had Mumbai, Delhi, Bangalore, Hyderabad. We've had 5 TOT projects that have come out. So it's been done. It's been done over the last 5 years, 10 years, and it's been done successfully. But I think, as Mr. Pai said, it's been done individually. And it is very important when you have these when you want to attract the kind of capital India needs, you need to show scale. India has been extremely fragmented, and that has been one of the biggest challenges for investors to come into India. As I alluded earlier, for them to write a $20 million check, a $50 million check is just not worth it. They need to look that, okay, if they're going to allocate to India, they are going to be able to allocate a couple of $1 billion in the next 5 years. Otherwise, India is not even on the map. It's not even on the allocation list for them. We need to get on that allocation list. And one of the ways to do it is showing, as I think Mr. Pai put it, this menu. So they can start actually looking at it seriously. And people then, they have small teams, investors have small teams. You need dedicated resources to start looking at the India market. They will do that if they see this pipeline. So I do believe that having this kind of approach to attract the kind of capital and the type of capital you need is very important. But having said that, Mr. Malhotra, I'm also aware that the government is now focusing on what is it in the short term that can be brought to the market. So through this large pipeline, what is it that we can actually bring to execution in the next 6 months? And I know that's a discussion that's happening because I know NIF is also involved in some of those discussions. And I think that's really the approach that is the right approach. You show this entire menu, but you also have, I think what you're alluding to is a clear short to medium term plan to make it happen. So I think that's all I want to say.
Thanks, Saloni. Manu, please.
Yeah, no, just one small part. I think Saloni has rightly pointed out. I think we need to talk in terms of now trillion. Even we started with crore, now moved to billion, and we need to talk in terms of the trillion. If you look at the gross capital formation by the private corporation, in 2019 it was merely, I think, 280 billion INR, right? It's very tiny size of the private sector investment that is coming from India, right? If we are aspiring still to reach a 5 trillion economy, right, by 24-25, we need massive amount of capital formation in the private sector. Now, I think it has to move from 0.28 trillion to something around 0.9 trillion by the private sector. I'm just dividing it between the household sector and the private corporate sector. So we need fourfold increase in the gross capital formation by the private sector, and from where the capital will come, unless we become little more aspirational. But Rajeev has also explained the right concern in the sense in terms of the prioritization, you have to really put it right. Otherwise, if we don't drive it, then sometime you might lose the investor confidence, right? So putting the plan and pursuing it and demonstrating to the globe would be the real challenge. And I'm sure that we are ready to take up that challenge and make it possible.
Great. Thank you very much, Manu. We have exactly 3 minutes left, which means we have 30 seconds for each speaker for closing couple of sentences. I'm going to start with Rajeev. Your comment can perhaps be merged with the closing remarks on how do you envisage this? And let's bring in some positivity also. It will work. It should work. It is likely to work. And everyone should be happy. What are your closing thoughts, Rajeev?
Right. So I'm optimistic about this initiative. However, the one thing where we have not done well, if you look at the last 10, 12, 13, 14 years, and I'm saying since the global financial crisis in 2008, is we have actually, through acts of omission and commission both, and when I say we, I'm saying basically the government, has increased the risks and uncertainties. I mean, uncertainty is not something that they could have handled on their own, and there was some of pandemic came from nowhere, but the risks haven't been answered or haven't been addressed. As the global economy slowed down around the global financial crisis, it was time for us to move and shift the levers domestically to compensate for the lack of sentiments coming from the global economy. And I think we failed miserably there. Large reason for that is political. And I would, if I can, say, and it is not just political mechanization of the current government, but it is also to do with the previous government. I mean, the 3 C's, the courts, the CBC, and the Comptroller and Auditor General threw in the spanner in the momentum that we were seeing in the private investments. And at that juncture, we needed to compensate for the lack of sentiments from abroad. We didn't do that. And we have continued to miss out on steps since then as well. So my fear, my optimism about this initiative has to be a little guarded, because history doesn't speak well of what we tend to do, or in terms of timely interventions to address the concerns of investors. There's no denying private investment has to pick up, and to get it moving, you need to do these kind of big ticket reforms, which can fire the animal spirits. But for them to succeed, you need to do a whole lot of other things. Unfortunately, not perhaps enough attention is being paid there, and that may undermine the initiative in the coming years. Thank you.
Thank you, Rajeev. Saloni, it's a terrific idea. It's a positive endeavor, but
No, absolutely. I think it's obviously it's a fantastic idea. I mean, I'm looking at it outside in, head of investor relations. That's the hat I wear. So I talk to investors. I know there's large pools of capital that is very interested in coming in and investing in this. But I agree, there are aspects that we have to take care of. I think consistency of contracts, ensuring that there is stability. There's stability in policy and regulatory environment. So the investors are willing to take a risk on traffic and growth, but they do not want to take a risk on policy and regulatory matters. And more important, governance framework. So in many cases today also we have privatizations, but we have the regulator and the asset manager as the same. So you need to ensure that all these structural aspects are taken care of to actually get that pool of capital that's looking in. So I think very positive, but we need to make sure that these structures are conducive.
thank you, Saloni. Manu, closing remarks. Grand idea, however.
Well, I'm very cautiously optimistic. I would say that there is a plan, and there is global interest as well, right? So as long as we protect the property rights, we have the strict contract enforcement regime, a very stable tax regime, and there is a level playing field between the private and the public players. I think that the interest would remain. I think India is the future of the globe. I think I am very, very optimistic about this country, and I'm sure that the investors also will be quite attracted to come and put money.
Thank you, Manu. Mr. Pai, you have the last word. It's a grand idea, no buts, right?
Well, all I'll say is that I'm very, very optimistic. I know that when you start with a nascent framework, that there is an evolution. But I'm confident that based on the individuals that I've been interacting with, that the mindset change is beginning to happen within government and without government, outside of government. And it will take time because I said even all the odds were stacked against PPP despite some tremendous work done earlier. But we are watching people embrace it now, and I think it will go through this process of evolution. On the flip side, I think, while Saloni did mention that the core, growth and the economic risk is one that investors, care about, but they care about those other things more. All I can say is in the second factor, we've done tremendous amount of groundwork. I talked about the foundational groundwork that we have done. Those are things that are easier, believe it or not, than some of the other systemic changes that are far more challenging in our system. But all of those, we talked about the financial, foundations that we have laid with the inclusion, with the amount of capital formation that will increase. We've talked about, the relative scale. We've talked about efficiencies that infrastructure will improve. So the overall, pitch for Saloni when she's speaking to all these investors all over is that growth is going to be tremendous. We had a massive reset because of the pandemic, which interrupted a lot of these track records. But that growth should not be underestimated. While we are sorting out all the other matters at a faster speed than historical, but still slower than most other countries in the world, hopefully it'll keep accelerating as we get better at this reform thing and better at getting the judicial alignment, better at getting the other alignments, clearing up all of that. I think we should not underplay the opportunity that India offers in terms of that growth, actual absolute growth and greater stability in currency than ever historically. So you just have a look at that. So that reserve is there. That story is what will help us attract people right now that will feed into that whole reform process and start feeding. I'll stop over there, but that's,
Mr. Pai, you just gave, it's my pitch. So you...
It's a wonderful thought to end the session that we should not underplay the opportunities that the economy can present. and at the same time learn from whatever mistakes that were committed in the past so that we can do a better job. Animal spirits are important. They need to come out in a big way, not in the way that we are seeing in an overheated stock market, which is in fact the topic of the theme for the next session, which is going to start at 11. So thank you very much, panelists, Mr. Ajit Pai, Dr. Manoranjan Pattanayak, Ms. Saloni, Jhaveri, and of course, Professor Rajeev Malhotra. Thank you so much for your time.